The script was written, verified, and approved by compliance professionals at Financial Regulation Courses. Series 65, Financial Regulation Courses. A bond ETF is a fixed income exchange-traded fund that holds a diversified portfolio of debt securities and trades throughout the day at market-determined prices. These funds combine the income characteristics of bonds with the intraday liquidity and price transparency of equity trading, providing exposure to nearly every fixed income segment. Bond ETFs have transformed the market by democratizing access to segments historically characterized by large transaction sizes and opaque, dealer-driven pricing for individual investors. Directly tested on the Series 65 examination, they are critical for understanding fixed income products, portfolio construction, and the specific comparison between ETFs and mutual funds. Understanding the core rule definitions and historical evolution is essential for regulatory compliance and professional practice within the modern financial landscape. The foundation of every bond ETF is the creation and redemption mechanism administered by authorized participants, large institutional intermediaries serving as primary market makers. An authorized participant can create new shares by assembling a basket of underlying bonds and delivering that basket to the sponsor for blocks of shares. Conversely, they can redeem existing shares by purchasing them on the secondary market and delivering them to the sponsor in exchange for the underlying bonds. This mechanism is the arbitrage engine that keeps the ETF's secondary market price aligned with its net asset value through continuous institutional trading activity. When the ETF trades at a premium, participants profit by purchasing cheaper underlying bonds and selling newly created shares, driving the price back toward parity. When the ETF trades at a discount, the reverse occurs. Participants buy cheaper shares to redeem for more valuable bonds, effectively arbitraging away the discount. Due to the OTC structure of the bond market, sponsors often use a sampling or cash component approach rather than pure in-kind exchanges of all index components. Bond ETFs trade at premiums and discounts more frequently than equity ETFs, reflecting the fundamental differences between the centralized equity and decentralized over-the-counter bond markets. Unlike equities, bonds trade through bilateral negotiations between dealers. Prices are less continuously observed, and intraday NAVs may reflect transactions from minutes or even hours ago. During the March 2020 disruption, bond ETF prices diverged significantly from NAVs, often functioning as a more accurate price discovery mechanism than stale dealer quotes. Operational requirements include strict on-premises boundaries and mandated dual-channel disclosure delivery mechanics to ensure investors receive timely and accurate pricing information. Crucially, a bond ETF has no maturity date. While individual bonds return face value at maturity, an ETF perpetually maintains its target duration and credit exposure. This means bond ETF investors cannot simply hold to maturity to eliminate price risk. They are always subject to fluctuations resulting from changing market interest rates. Bond ETF investors typically receive monthly distributions representing the interest collected from the portfolio, providing more frequent income than the semi-annual payments of individual bonds. ETFs provide immediate diversification across hundreds of issuers, dramatically reducing the impact of any single issuer's default on the total return of the investor's portfolio. Through in-kind redemptions, bond ETFs systematically remove low-cost basis bonds without triggering taxable capital gains realization, offering a structural tax advantage over conventional mutual funds. Supervisory controls require WSP integration, regulatory access clauses, and strict books and records retention cycles to maintain jurisdictional oversight of these complex vehicles. Investment advisors must assess suitability under the fiduciary duty of the Advisors Act and Regulation Best Interest, considering expense ratios and the absence of a maturity date. Key takeaways. Bond ETFs provide liquid, diversified, and tax-efficient access to fixed income, though they lack the certainty of principal return found in individual bonds. By understanding these structural mechanics and suitability considerations, you are better prepared for the Series 65 exam and professional practice in the financial services industry.